Good morning, everyone, and a warm welcome to all our clients and financial advisors that dialed in this morning. I'm Louis Duplessis from Old Mutual Wealth, and I'm very pleased to be your host today, even though it's under some unusual circumstances. From our perspective, the national lockdown has certainly forced us to find different ways of engaging and supporting our clients using technology like the digital platform we are using today. Earlier today, unfortunately, we did experience some technical difficulty in a similar session, and this was as a result of the increase in global usage of Microsoft Teams technology. Should this happen again, we'll make a recording of this presentation available to your financial advisors, and we're also happy to have smaller, more interactive sessions. The purpose of today is to provide you with an overview of the impact of the coronavirus on the local and global economy, but also more importantly, what to expect going forward as investors. To share his insights with us, we have Dave Mohr, who has seen all the ups and downs in the economy over the last 40 years. Dave was Old Mutual's chief economist for 11 years before joining Citadel as chief investment officer for 15 years and rejoining Old Mutual Multi-Managers about 7 years ago as the chief investment strategist. Before I hand over to Dave, just two practical notes. Dave will not be able to see you or hear you as this is a live broadcast. We do, however, invite you to type your questions in the chat box, which you can find in the top right-hand corner, and we'll answer as many of those questions after the presentation. Thank you, Dave. Over to you, and let's hope the technology holds this time.
Thank you, Louis, and good morning to everyone out there. Hopefully you will find this overview insightful and ask questions afterwards, as Louis has said. We start off with the bottom right-hand slide, or the photograph there. You can see that's the first two coronaviruses identified in China some time ago. And top left, you see the update, nearly 2 million, probably as we speak, more than 2 million people infected and deaths way over 100,000. That's the virus. I'm no expert on the virus. I think a lot of you obviously read a lot more about it. So let's rather concentrate on the markets. And I think the first question is, how did the market miss this? Because markets were still going along happily until the 19th of February this year. And if you look for the reasons why markets initially ignored the virus and the potential impact of it, I think it's short and simple. This is not the first virus that we've seen. During my career, we've had, the SARS, the H1N1 virus. I mean, there have been many. I mean, some of you remember as recently as 2016, a lot of athletes didn't go to the Rio Olympic Games because of the Zika virus. However, what I think we missed with this one is the fact that it spread so quickly, and that although the mortality rate was much lower than previous viruses, the complication rate, so the number of people going to hospitals, was much higher. And that completely overwhelmed the health systems of countries outside of China. And that led to a government reaction of locking down the economy, or you can even think of shutting down the economy. Now, if we look at the rate of shutdown, by the 21st of January, there were very few countries, or nobody was basically shut down. Wuhan was only shut down on the 23rd of January. And this is data that information got from the Financial Times. Then if you look at where the world was, a month, 2 months later, largest part of the global economy is now under lockdown. And the lockdown, I think one can better describe, as I said, as an economic shutdown. So essentially what you do is you close businesses. You don't allow consumers the ability to consume as freely as what they wanted to. So to summarize those economic shocks and to try and look at the impact of the shock, the magnitude of the impact of the shock, I used two graphs from China to start off with. This shows the production growth from China, from their factories. It was happily growing up till the end of last year at a rate of between 7 and 8%, and then all of a sudden started shrinking between 10 and 20%. If we look at the impact that factory shutdown on production, and we compare it there to the 2008-2009 global financial crisis, one can see the economic impact has been a lot worse. Similarly, when we look at demand, this is a graph of retail sales from China. So what ordinary Chinese spend, the growth in retail sales, it was rapidly growing at about 10%, and the next moment it was shrinking at a rate of 20%. Again, if we look at the shock to the economy and we compare it to what happened during the financial crisis, it's clear that we're talking about something that's way bigger, more severe than the financial crisis in terms of the immediate economic impact. Now, China has slowly but surely been trying to get out of their lockdown, but at this point, economic activity in China is still between 15 and 30% lower than where it normally is this time of the year. But not only can we use China as an example of the economic impact, in the US, if you look at unemployment numbers, we see something similar. This is the graph showing the weekly new claimants for unemployment benefits in the US. So if you lose your job, you go down to your labor bureau, you register as being unemployed, and then you get benefits for the next few months. So the number is only the new applicants in any 1 week. And there one can see over the 2 weeks, up till 2 weeks ago, 10 million people registered for unemployment benefits within a 2-week period. Subsequently, another 10 million has applied for unemployment benefits. And again, the striking thing is, if we compare that to what the new claims for unemployment benefits were like during the financial crisis, there you can see it was pointed out, it was of the order of about 665,000 at its worst. So now here one can see is this is more than 10 times worse in terms of the employment impact in the US compared to the financial crisis that hit the US just over 10 years ago. So yes, I mean, the world is probably facing the biggest crisis since the Second World War, and the global economy is facing the biggest crisis since the Great Depression. If we look at another angle in terms of the economic impact, it is the impact of the virus on confidence levels of individuals, of companies, even of governments. And as we know so well in South Africa, confidence levels play a hugely important role in what happens to economic growth. So with the setback to confidence, that would further, complicate things for economies all over the world. But not only is it the confidence that's being impacted on currently, it's how we're going to behave as we gradually get out of this crisis over time. So behavior will change because history has shown when people go through a period of trauma like this, they behave very differently once it's over. For example, if we look at the US during the financial crisis, millions of Americans lost their jobs and homes within a fairly short period of time. And their behavior changed so in terms of that trauma that they went through, that in the subsequent 10 years, despite record low interest rates in the US, the average US consumer did not increase his or her debt burden, and that is their total debt relative to their incomes, in the next 10 years. Whereas typically any economic model will tell you, or should tell you, that if you lower interest rates, people will borrow more, therefore they will spend more, and therefore there will be more economic growth. But here one can see how that behavioral change, because of the trauma that you go through for a 10-year period plus, can turn the traditional economic model upside down. And we will still have to think long and hard about how behaviors are going to change in future and how that's going to impact on economies. Just think of the behavior of financial markets. Let's say once this virus is behind us, and a few years from now, we open a newspaper, look at Facebook or whatever, and we see there's been an outbreak of a new virus somewhere in the world. Guess how markets are going to react then, following the trauma that we've experienced over the last couple of months. So yes, I think we've seen the initial impact. The recession, there's no argument about the recession. The only argument is how bad the recession is going to be. It's going to be worse than anything, I believe, since the Second World War. And the other question is how quickly can we get out of that recession? And I'll get to that in a moment's time. The major thing that has stood out is how banks and government reacted to the impact of the virus on economies. And I think the quick reactions that we've seen and the magnitude of the packages that have been announced to try and assist economies is exactly because what we experienced during the global financial crisis, whereas initially governments and central banks were not really in favor of doing radical things to try and help the economy. But as America showed us, the more radical you were in your approach, the more you ignored the rule book, like during the financial crisis, the quicker you came out of the crisis and the quicker the economy recovered. And we know over the last 10 years, one of the best performing stock markets in the world, for example, by a country mile, was the US stock market. So the policy response to the crisis has been big. Central banks slashed interest rates to basically zero and have engaged in open-ended quantitative easing. Now, quantitative easing is a process whereby central banks like the Reserve Bank or the Fed or the Bank of England, they provide funding for the economy, which is not their typical role, but something that started during the financial crisis and persisted right through the previous decade. This time around, I think central banks have been more aggressive, quickly implementing quantitative easing, and that's had some impact, I think, in certain areas already. Quantitative easing is also described by many as printing money. And the fear is if you start printing money, that inflation is going to go up. But luckily, we've had the example now of 10 years of quantitative easing. And after 10 years of quantitative easing, inflation was lower at the end of the previous decade than where it started during that decade. So this notion that quantitative easing is inevitably going to result in higher inflation is one that I don't necessarily agree with. In addition to central banks, governments have borrowed more and they're spending more to try and counter the impact of the virus, of that slowdown, of that lockdown that we're seeing globally. The developed countries, the major economies, they've got the advantage that their governments can borrow at very low interest rates. So a lot of these borrowings, they can afford. But central banks are helping them with that as well. For example, if you look at the Bank of England, it's now basically opened up a facility, which is like an overdraft facility that the government can use directly to fund extra spending to fight the virus. And we've got plenty of examples like that all over the developed world and even in the developing world in certain countries. How much governments are spending extra is illustrated by the next slide. This gives you an idea of government spending, those fiscal packages as they talk about, as a percent of the economies there, the 10 major economies in the Western world. And there one can see, if you look at the US, the size of their economic package that they agreed to is more than 10% of national income in 1 year, and that adds up to $2 trillion. Other countries, you can see, the packages are a bit smaller, but overall, we have never seen the likes of such a fiscal spending surge about to hit economies. Obviously, that's against the background of economies that are weakening at a rate that we can only guess how big it's going to be at this stage. The initial economic forecast, as you've all seen with the IMF and the Reserve Bank the last day or so, they've hugely increased how big the decline in economies are likely to be because of the virus in recent days. So I think, yes, one can spend time on trying to forecast the economy. I think, like us, we're working on the basis this is the worst we've seen since the Second World War. That's for the developed countries. So they've got lower interest rates, more quantitative easing, lots of government spending that they're funding at very low interest rates, and their central banks are helping them with their funding as well. However, if we get closer to home, we live in an environment globally that's called the emerging markets. And unfortunately, when a crisis hits the global economy, then money tends to flee from emerging markets. You get a capital flight out of emerging markets. This time round has been no different. The only difference is if we compare the flight of capital from emerging markets like South Africa under these circumstances to what happened during the global financial crisis. That's the light blue line on your screen there. One can see that this one is about 5 times as big as the flight of capital was from emerging markets at the height of the financial crisis. So emerging markets are not only having to cope with the impact of the virus, also locking down the economies, but it also has to cope with this massive flight of capital that we've seen. And South Africa, being one of the bigger financial markets within the emerging market sphere, has struggled because of this. It's estimated by the Reserve Bank that over that period, where you can see the 100 billion has left the emerging markets, that's billion of dollars. South Africa got a hit of about 100 billion rand. So 100 billion rand leaving our markets, whereas in total, if you translate it into rands globally, about 1.5 trillion rand leaving our markets. Now, when you get capital flight like that from your financial markets, what happens? Well, 2 things. The one is it will put upward pressure on your interest rates, long-term interest rates, those interest rates that are determined by markets and not by central banks. And here you can see the blue line. That's the 10-year government bond yield of South Africa. And then I include some of our peers internationally, Indonesia, Brazil, and Russia. And there you can see how their interest rates were hit very similarly to ours as that flight of capital started a month or so ago. Now, one can see over the last little while, those interest rates eased back a bit, more so in the other countries than South Africa. However, for South Africa, what is important, over that period, we also had the downgrade from Moody's that now finally has resulted in all the big credit rating agencies downgrading South Africa to speculative status. Now, that's the popular word for that is junk status. However, what I want to point out is that since we've been downgraded, interest rates did not jump in South Africa. It jumped prior to that, but that was because of those global capital flows fleeing from emerging markets. Since the downgrade, long-term interest rates have come down 1%. Now, quite often people ask me, what does a downgrade mean? All that it means is that, for example, you go to the bank manager looks at you and he says, well, I hear you're working part-time now, you're not working full-time anymore. So we think your credit risk has increased. So yes, you can still get a credit facility from the bank, but we're going to charge you a little bit more interest on that to reflect the higher risk that we think you represent, only working half day and not full day. Now, against that background, all it means is that relative to what other people pay, you will pay a little bit more. But what will move your interest rate more is if everybody's interest rate moves up and down. And here you can see that has been the case during this downgrade. Funny enough, this downgrade couldn't have come at a better time because we're seeing massive downgrades all over the world as economies and businesses come to a standstill. Now, the popular view was that if we get downgraded in South Africa, interest rates are going to jump through the roof and the currency is going to fall through the floor. Here we see long-term interest rates, in fact, since the downgrade has come down, and short-term interest rates, they were cut again by 1 percentage point this morning, and overall short-term interest rates have come down 2 percentage points in a very short period. So interest rates since the downgrade has come down in South Africa, and that says downgrade is not as important as what happens on global financial markets, determining where our interest rates will be where our currency would be and where our equity prices would be. Speaking of the currency, let's look at how the currency has performed over the last little while. And again, to explain the graph quickly, the blue line there shows you the combined currency movements of other commodity producing emerging markets. Now, those are the countries that I consider to be our global peers within global financial markets. Those 5 countries are Brazil, Chile, Mexico, Russia, and Indonesia. And there one can see, although the short-term movement of their combined currencies and the rand does not fully correlate in the short run, if you look at it, medium and longer term trends are very similar. So the lesson here is that what happens to our currency has got less to do with what happens in South Africa and more to do with what happens globally. I'm not saying South Africa is of no significance. I'm just emphasizing that as South Africans, we totally overemphasize the development of, or the impact of local developments on the movement of our currency. And there one can see over the period, very similar to those other currencies, both came under pressure. Obviously, this is expressed as the local currency relative to the dollar. So when the graph goes up, the rand or those other currencies depreciate against the dollar. So the weak rand has moved basically in line with these global forces, the outflows from emerging markets. Then if we get to South Africa, what we're doing, unfortunately, we haven't got the luxury and the scope because of the pressure those capital outflows are placing on us, because of the vulnerable position our economy was already in as this crisis hit us. But the Reserve Bank has acted and has cut interest rates by, as I said, overall 2 percentage points. I think we cannot rule out further cuts in coming weeks and months. So if you look at the return that you're getting on your bank deposit, short-term bank deposit, I think very soon it won't be much higher than the inflation rate and perhaps could even be a little bit below the inflation rate. The Reserve Bank is also, if we look at the summary of our monetary and fiscal measures, now the monetary measure, that's what the Reserve Bank is doing. So the Reserve Bank has cut interest rates and it has provided liquidity into the secondary bond market. So that's where the government would be borrowing money from to fund our deficit, is in the bond market. Once the debt has been issued, it gets traded amongst pension funds, amongst South Africans and foreigners, etc. That's the secondary bond market. And the Reserve Bank is helping to supply liquidity in that market. Over the last month, it bought a little bit of, on a net basis, government bonds, but only to the tune of about R1 billion. Secondly, it's also providing liquidity into the repo market, and the repo market is the money market. That's the short-term funding market that helps the economy to tick over. Okay, so that's where you typically find where your money market funds would invest. Then the Reserve Bank has also got a facility to borrow dollars from the US Fed to the tune of $13 billion so that they can provide liquidity in our rand dollar market, so that there would be dollars available, easily available, obviously not being able to determine the price of it, but at least available for people that want to buy dollars over this period. So the Reserve Bank is playing a major role in providing liquidity into our financial markets, but they have not engaged into quantitative easing, and they're not assisting the economy and the government directly in terms of their funding needs. Then on the fiscal side, some things have been announced. I think the key thing is that our budget deficit is rising very rapidly. It will be way north of 10% of the size of our economy. In a recent budget, the minister budgeted for a deficit of just less than 7% of GDP. We've borrowed about $1 billion from the BRICS Bank, the new development bank. But as a percentage of the economy, one can see it's about 1/3 of the percent of the economy. So compared to those other interventions that other governments are doing that are on balance 6-7% of GDP, you can see that's nothing in terms of the money inflow. There's a emergency facility available from the IMF that the government can borrow at. I think at some point the government will make use of that. But let me just emphasize here, that's not the normal IMF loan that you read about so many times in the newspapers. That comes with a lot of policy conditions attached to it. This is an emergency facility at the IMF that governments can borrow from to try and help fund their fight against the virus, to try and help their local economies. And it comes at a very low dollar interest rate as well. In addition, we expect new measures to be announced from government within the next week. So we'll have to see. Overall, if we look at the fiscal measures announced in South Africa, it's nothing compared to what I showed you the major economies have been able to do in their economies. And that's because we haven't got the resources at our disposal at this point in time. Then the private sector has also helped in the efforts. A little bit of money from, well, a little bit, it's a lot for those private foundations, but in terms of the total, it's a fraction of a % of the total economy. And remember the Rupert family's contribution, I think it was R1 billion. Within 3 days, that was taken up through the Business Partners organization with small businesses that applied for funding to business partners. And there's also the Solidarity Fund that everybody can contribute to. At Old Mutual, we're in a position where we can salary sacrifice at the end of the month, and that money will be paid into the Solidarity Fund. I think the bottom line, though, is that if we look at our measures to try and counter the economic impact of our lockdown, it is very, very small compared to what's happening globally. Then what's in it for investors? Let's look first of all at how asset classes have performed. These numbers are all in rands. And there you can see the typical asset classes we would invest into in our balanced funds. One can see the dotted red line, that is global equities. The combination the last while where global equities have bounced back and the rand appreciated, which is a positive double whammy for your rand returns from global equities. It's almost made up the losses incurred on the rand values of global equities. Similarly, global property has bounced back nicely as well. South African government bonds suffered during this period. It looks like there, if you look at the end of the slide, it looks like the bonds are going sideways. But we realized this morning that the international database that we're using has not updated South African bond returns since the beginning of the month, it appears. So that has already improved, as I'll show you just now, as bond yields have come down a bit in South Africa. And as you're well aware, the JSE, before it fell back a bit this morning again, was at close last night trading almost back at 50,000, having bottomed below 38,000. And our property shares that got slaughtered also rebounded nicely, but off historic lows that we haven't seen for many years. Talking about bonds, if we look at South African bonds, I showed this slide earlier. This is just a longer term slide. The green line shows you our bond yield. There you can see how our bond yields have come down over the last little while. We think bonds represent a very good investment still in South Africa, because if you look at where our bond yields are relative to those global bond yields, even other emerging markets, our bond yields are very attractive in South Africa. And particularly against those global markets where bond yields are almost nothing, where interest rates are close to zero, long-term interest rates and short-term interest rates. And if you look at the gap between what you can get, the interest rate that you can get on a long-term government bond versus inflation, that's at historically attractive levels as well. So our bonds suffered because of the emerging market capital flight, not so much because of the downgrade. But over the last little while, that situation appears to be stabilizing and improving a little bit. Then if we look at equity markets, obviously as equity markets fall, equity valuations become cheaper. Now all this is, I'm showing you the price earnings ratio. So this is the price of a share relative to the profits that have been made over the last 12 months. So the lower the PE ratio, the cheaper equities would be, and the higher the PE ratio, the higher equities would be. The blue line there represents global markets, and the green line is our own JSE. And one can ask, why did the JSE trade as recently as 2016 at a higher PE than global markets? That's because of a Chinese company that dominates the JSE. Through its holdings in Tencent, Naspers and Prosus make up 25% of the local market, and it trades on a very high PE, as all successful tech companies do globally. If we strip that out, that premium that South African market commanded at 2017, 2018, that will disappear. Now we can see, despite the weightings of Naspers and Prosus having gone up, because you've noticed those shares have done well, our rating has fallen to well below global equity market ratings, but both ratings have fallen quite substantially. In these times, to look forward is very difficult. As I said, one can only guess how negative economic growth is going to be. I think numbers closer to -10 rather than -5 for a whole range of economies, including ourselves, is well within a likely outcome for the future. However, as investors, how do we make decisions about investments under these circumstances? Well, to try and speculate about things that are hugely uncertain, radical uncertainty, will not help us much in establishing what we should be doing currently. At Old Mutual Multi-Managers, we'd like to focus on current valuations. And what I've done now here is I've translated the cheaper valuations that we've got for bonds, because the higher the bond yield, the cheaper the valuation, and the lower PE ratios for equity markets. We've tried to translate that into what potential returns could be from asset classes from where our markets were at the end of March this year to where markets are likely to be once the dust has settled, once we're over the lockdown, once economies function normally again, and once equity market valuations return to where on average they've been over the last 30 years. So we've got three things. The virus must disappear, or the impact must be greatly diminished. The second thing is that markets must return and economies must return to more normal levels. There you can see that then the blue bars represent from end of March to that unknown time in future what your potential returns can be from various asset classes locally, as you can see there, the SA ones and the international ones on the right-hand side. The yellow dots provide us with the potential returns we think under normal circumstances that, equities and property and bonds and cash will give you over time. And that's based on our long-term history analysis. And the bar charts represent that number from the end of March to that point where things normalize at some point in future. I must just emphasize again, this is not a forecast. This is saying from these bombed out levels for markets until the dust settles, this is where you can find potential returns within certain asset classes in financial markets. And one can see, obviously, with our market that was harder hit than global markets, the potential returns are higher in South African assets compared to global, but it comes at a much higher risk as well. So it means the chances of getting it, you got to weigh up against what the underlying risks are. Then what have we been doing in our portfolio? What has worked? We've always run a full exposure to global assets in our portfolio because we thought always it was important to diversify away some of the South African risk. We were underweight global equity and property, and the extent of the underweight is we probably had between 70 and 75% of the exposure to SA equity and property then compared to what we would have had traditionally. So we've pared that back by about a quarter compared to what over the long term your exposure would be to equity and property. Looking back, it was probably not enough, but hindsight is the luxury that doesn't help you anything investing for the future. What hasn't worked is our fixed income, those bond yields that got hurt, and those bond returns with a flight from capital from emerging markets, including South Africa. But since the downgrade, we've seen that long bond yields are now a bit lower and cash rates have come down. So we are still happy that that type of investment still offers very good potential returns in the local market. What have we been doing? As you can remember from showing the asset class returns at the start of this section, global did much better than local. The rand has been pummeled over this period as well. So we brought back a little bit of the offshore outperformance that we've seen back locally. At this stage, we haven't invested it. We're keeping it in cash, but that's a small percentage of the overall portfolio or the overall positioning within our funds. Then lastly, I haven't promised you anything in terms of when the economic crisis will be over, when markets will bottom. But the last two slides I want to share with you is to say that to try and time when equity markets turn is basically impossible. And there's some good reasons for it. The first one is often people think that, when you're suffering, when you see how your investments are going down, your equity investments in particular, they ask the question, shouldn't we be selling now after the markets have fallen, then wait for the dust to settle, the calm to return, and then reinvest back into equity markets? And that is a timing exercise, but I think that's a timing exercise that is very, very dangerous. Because if you look at when equity markets turn, they typically turn much earlier than you think. And by the time the dust has settled and the calm returns to equity markets and economies start functioning normally again, you find that equity markets have rebounded significantly already. This graph shows you the green bars, the economic cycle in the US during the financial crisis, and there you can see how the economy shrank at one point. And the blue line, that's the US stock market. So there one can see how the stock market bottomed long before the US economy bottomed, long before the dust is settled, long before the uncertainty disappeared. And by the time the economy was starting to grow positively again compared to a year ago, the markets had already rebounded 50% plus. And as many analyses have shown, that if you miss these bounces in markets, your long-term return from equities is going to be disappointingly low. And therefore, if you want to take the risk of investing in equities, I think the best advice is to stay invested through the cycles and to stick to equities to realize those promised longer-term returns, potential returns that I showed you in one of my previous slides. And this is a recent example, but I want to take you back in history a bit to look at the turning points in equity market cycles. Now, the LSE, that's the London Stock Exchange, was open right through the Second World War, except in the first week that war was declared in 1939. During that period, the London Stock Exchange suffered a setback and then bottomed. And my question to you is, when do you think that bottom was? Was it at the end of the war when everything was over and the dust had settled and things were getting back to normal? No, it was long before that. Was it when the Allies invaded Europe during D-Day? No, it was long before that. Was it at Pearl Harbor, during Pearl Harbor, when all of a sudden the US woke up and joined the Allies and tipped the power balance in their favor? No, the turning point was long before that. Here you can see the bottom line. That is the London Stock Exchange as it traded during the war. And the turning point was at the end of the battle and the evacuation of the British and French troops from the beaches of Dunkirk. The market bottomed during the darkest moment in the history of the UK, as Churchill put it so grandly in that famous speech of his. So don't try and time these things. It happens a lot earlier than you think, and it happens at a time where all the news around you is negative, and you wouldn't guess that that could be the bottom of the market. The interesting thing here is, by the time the US joined the war effort, the market had already fully recovered the previous losses and was back to where the market was before the outbreak of the Second World War. To summarize, there's a lot of uncertainty still around about the economic impact and the virus. And I think we have to accept that. We cannot base an investment strategy on making wild forecasts about what's happening to the virus and what's happening to economies. Markets have gained confidence that the global response, the fiscal response that we talked about, the monetary response for central banks, and the combo of that with some evidence that new cases of infection are peaking, has improved market confidence, and hence the rebound we've seen in markets in the recent 2 weeks, which has been a big rebound. Now, the big question is, between the first point and the second point, do we think that globally the authorities have done enough to keep the economic impact of the lockdown, the impact of it, to a bare minimum, and to ensure that once the lockdown is over, that economies return very quickly to normal? Markets are giving that scenario some probability at the moment, and as I said, that's why markets have gone up. But I see it as a race between what's happening in terms of the new infections, how long it will take for economies to get back to normal, and whether the firepower that central banks and governments are supplying now will make up for the shortfalls in economic activity that we're seeing at this point in time. That's an uncertain question that I cannot answer with any confidence, unfortunately, at this point. The other thing is, we must accept that markets will remain volatile. I always laugh when people ask me and they say, "Jeepers, but markets are volatile at the moment." And I say, yes, but they're always volatile. Sometimes they're just more volatile than other times. Locally, South Africa faces a massive challenge. We haven't got the firepower to try and counter a lot of the negative economic impact of the lockdown that we're seeing. We went into the crisis already vulnerable. But our asset prices are reflecting that vulnerability and those challenges facing the local economy. So it's not just a question of dumping all South African assets necessarily at this point, as we've seen over the last 2 days, last 2 weeks, how quickly asset prices can recover on the back of what's happening globally. And lastly, I showed you those potential returns available from asset classes at this point. And I must stress, you need a long-term time horizon to potentially unlock those values. Thank you very much. That is the end of my story. And Louis, can you let us know if there are any questions that I need to answer?
Thank you very much, Dave. As Dave mentioned, this is an opportunity to ask some questions. All you have to do is click on the live event Q&A on the top right hand corner. There's a little question mark, and we've got a few questions so far, Dave. So the first one is, what are the 3 most important factors that will influence the shape and the duration of the world economic recovery? And thank you, Derek, for that question.
I think undoubtedly, I think that's not a very difficult question. I think it's the extent to which we can unlock economies. So that is the first thing. And as I said, that will depend very much on how quickly we can get the virus under control, with confidence that there won't be a second wave. Because the second wave is quite common if you look at history. The second thing is how businesses and individuals are going to behave into an unlocking of the economy. So what I'm saying is the authorities might unlock. How quickly are we going to get back to normal? And I think that says to me, the way we're going to react would be typically, I think it will make the recovery a lot slower. And then the last one is how long, in terms of the policies that governments follow, will they persist with the help? Because I think into the unlocking, the need for assistance from both the fiscal authorities and central banks is not going to disappear overnight. So if they read that correctly, and supply enough medicine to the economy, the healing can be quicker. So it's the virus, how we react, and how policymakers react.
Brilliant, thank you very much. I think we've got an interesting question here around the initiatives to support SMEs, but that the impact has been quite limited so far. And like you also mentioned, a lot of the applicants have been suspended due to the high demand and the backlog. The question is, do you expect new and more initiatives to be introduced to assist SMEs?
Yes, I hope so. The problem with SMEs is the channels aren't so easy. The delivery mechanism of trying to do it is not so easy. But I do expect they will be included in the package. I think we're likely to see, as I said, within the next week, to be announced by government.
Great. I think we've got 2 or 3 more. Question is, what do you see the Rand doing? Do you see the Rand recovering?
I think if we look at the Rand, as the dust settles internationally, the Rand should improve, because a lot of the depreciation of the Rand that we've seen was because of the panic fleeing of capital from emerging markets. So as things settle down globally, emerging markets, that the money that left emerging markets start returning to it, I think South Africa will get its fair share of that. And under those circumstances, the Rand should improve. When that's going to be and by how much is going to improve, I don't know. All I know is, having followed our currency ever since it started floating in the early 1980s, is that when it's depreciating, it can depreciate more than you can imagine. I'm not talking forecast, more than you can imagine. And as we've seen quite often, when it starts appreciating, something similar happens. It can appreciate further than what you can imagine today. But yeah, the outlook is uncertain. I think it's not directly because of what's happening in South Africa. It's what's happening globally. As that improves, the situation improves, the Rand can improve.
Thank you, Dave. Then part of what Old Mutual multi-managers do is the strategic asset allocation, like you spoke through. The question is, what strategic asset allocation should I have to maintain? Should I have to maintain my global purchasing power over time?
Well, if you want to change, global purchasing power, there are various ways of doing it. What I'm saying is you can invest locally, and remember, a balanced fund in South Africa. I said that, we are underweight South African assets. So let me just illustrate to you. If you look at the JSE, one must realize that more than 50% of the JSE is global and not local. So we all know that Naspers process, etc., that is basically global and not local. If think of the likes of Richemont and British American Tobacco, that's global, not local. So what I'm saying is, if you invest in your normal balance fund in South Africa, you would find about 15% of your overall position will be linked into the local economy. And that would be your equity part of it. And you would find that more than 30%, which would typically be up to about 50%, will be influenced by what happens globally. And the South African part will be influenced by what happens globally as well. So it's a long explanation to say that you can preserve your global purchasing power by investing in a typical balance fund, like the Old Mutual multi-manager balance fund of funds. Then there's the other route that you can go. You can invest globally to try and secure your global purchasing power. If you invest globally, remember the main thing that you should do is you should accept that your global purchasing power will be going up and down as global markets go up and down as well. So let's say you want to invest and say, no, I don't want to take that chance. I want to invest in US dollars. Just remember, you get no interest on US dollars. So your purchasing power will be eroded by the 2% inflation that you're seeing in the US every year. So there's no easy answer to that one. But I do think it does not imply that you cannot protect global purchasing power by investing in a well-managed domestic balanced fund that's got significant global exposure.
Thanks very much. The questions are starting to come in. The next one thank you, Gareth. Do we expect the South African equity pricing to still look cheap once companies announce updated earnings after or during the lockdown?
Well, I think that's the reason why the valuations are cheap now. Because remember, markets look ahead. So as the economy shut down, markets were starting to price in that company profits were going to plummet. Whether it is cheap enough will depend on how big the fall is going to be in company profits. It's very difficult to predict at this stage. I think company profits will decline significantly in South Africa and globally. But that's the trick in terms of equity market valuations and how quickly equity markets adjust. So it has adjusted to the reality that company profits are going to be lower. Whether it's adjusted enough, that's an open question that I haven't got an answer to.
Thank you very much. Maybe a more difficult question, Dave. As an investor, and this is more about individual securities, as an investor, which global equities are attractive to invest in at the moment?
I'm not a global equity specialist in the sense that you should be buying company X, Y, and Z. I think there are lots of very capable global asset managers out there. In our business, we do a lot of work investigating those global managers. And we have got a product now that you can invest into, where we invest in a range of those global managers that we think are, best of breed, where you get a good diversification between manager styles of investing. And I think that's to my mind, the route to go. But yeah, I think under these circumstances, to exactly say, well, it should be this sector or these types of equities, we'd rather leave that to your global equity managers.
Great. Question here. Are we saying that it's an opportunity to look to bring your foreign funds back to rands to benefit from the strengthening of the rand and better interest rate and investment opportunity in South Africa?
I think the short answer to that is that if you look at somebody that is withdrawing from his or her portfolio or has got foreign assets, I think that would be a good thing, so that you put something away for spending needs that you need to fund within the next year or two. So if you've got that kind of time horizon, it makes sense. The second thing is that how we think about investment markets currently is that a part of your portfolio you would always be earning interest on. That part of your portfolio should be in South Africa because we offer such attractive interest rates, particularly long-term interest rates relative to global. In terms of growth assets, we still think that the global growth assets are probably, on a risk-adjusted basis, more attractive than South Africa. So we are overweight our global equity and we're underweight our local equity. I would rather have a well-diversified portfolio that is suited to the needs of the individual investor. And that's something that your investment advisor, your financial advisor must help you with in terms of the analysis that you do for individuals. So I wouldn't recommend to just say boots and all take advantage of the strong currency and bring everything back in South Africa, I think that's too risky an approach.
Thank you, Dave. I think we're going to finish with two more questions. Property is an asset class that always sparks a lot of debate. And the question is, what is the view on the South African property market this year?
Yeah, if we look at, I guess that's listed property, Louis.
Yeah.
Yeah, let's say it's listed property. Again, if the listed property we look at in South Africa is 50% South African, 50% global. The property market has derated. If you look at, I didn't show the PE ratios for the property market, but if you think of the yields that you can get on property, it's somewhere between 12 and 18%. Those are very attractive yields available on listed property in South Africa. The only thing is, we talked about behavioral change earlier, and if you think of that behavioral change, the one area that's going to be impacted on is property, and particularly in terms of retail. Social distancing, you'd rather be buying something over the internet, and that has got some negative impact on property. However, if you look at how property has been hammered over the last little while, it's an asset class that we've been paying close attention to. In our balance fund, we've only got 1.5% of the fund exposed to South African property. And we're looking at opportunities to perhaps increase that. So we think, yes, property prospects are not rosy, but it's one of those things that if you look at where property prices are now, of the listed prices, listed equity property, it's probably reflecting most of the bad news.
Brilliant. And we're almost on time. So I think we're going to finish with this $1 million question from Keith. Is it a good time to get into the market now?
I think that's the easiest question. If you had cash up to now, you should have invested already 3 weeks ago. Thank you.
Thank you very much, Dave. Really appreciate it. We trust that you found today's session valuable, and thank you again for everybody for dialing in. I think the two key messages that I took from Dave today was, number one, stay invested to ensure you don't miss out on the market rebound, as it happens very quickly, as we've seen over the last few weeks. And number two is to have a financial advisor at your side that really understands your life and goals and to support you through these volatile times. All your specific financial advisors have direct access to Dave, to the fund managers, and we keep them up to date with everything related to your investments. So you're in good hands. Thank you, everybody. Good luck for the remainder of the lockdown, and we really look forward to engaging with you again soon. So that concludes our presentation today. Thank you very much and stay safe.